Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
So I want to get into this discussion about mortgage forbearance. You've heard of it. You've probably read about it. I mean, forbearance has been discussed for the last 18 months. It was the government's attempt to help Americans by creating a remedy for those people that were materially affected by the pandemic. I mean, those people that were designated as non-essential. And there were a lot of Americans that fell into that category because the type of jobs that they had were maybe in the service industry or other industries that the government did not deem essential to the continuing operation of our country. Yeah, so if you weren't like a grocery worker or you weren't in construction or you weren't in the medical field or you weren't in the military or you weren't in law enforcement, you know where I'm going. You may have been in that category where you were materially affected. You were told you need to stay home. Oh, by the way, you're staying home and we're not going to pay you. So the government is going to allow you to go apply for unemployment. And the government's going to beef that unemployment up. That's supposed to help you get through the entire process. Now, I know for a fact that there are people out there in America that actually made more money through unemployment than they did actually working. That's part of the problem we're having now, is that people are like, why would I go back to work? Why would I do that if the government's going to pay me to sit at home and watch Oprah? Yeah. I mean, come on, it's kind of a no-brainer, right? So the government started paying people to stay home. Not everybody that went on unemployment made more money than what they earned when they were working. I'm just pointing that out because the government isn't very efficient or effective at doing a lot of things. Yeah, because they're trying to please too many people at the same time. Yeah, so what you get is a mediocre result. But think about it. There were people that owned real estate, either as investment property or they owned it as consumption property. Now, I define consumption property as the house that you buy to live in because it doesn't provide you any income streams. All you're hoping for is that it's going to go up in value. And then you're also hoping that you don't spend more money on repairs to maintain that thing. So that, when you get a return, if you sell it, you actually make some money. Yeah, that's not investing. That's living in a house that might go up in value. Yeah, that's what it is. But there were a lot of people that owned property. There were a lot of people that, maybe got into a little bit of a financial problem. Because it's very possible that they couldn't go back into the workforce. Now, I know a lot of people, and some of those people were residents in properties that I owned. I know a lot of people that just said, you know what? I'm the breadwinner. I'm stepping up here. Okay, I can't go work over here in my nice job that I've got, working in an office with air conditioning. I'm going to go over here. I'm going to work for the grocers because the grocers need people because all of a sudden there's demand, right? And there are some people that said, hey, man, I don't care if I'm essential or not. I am not interested in contracting that disease. So that created vacancies for other people to fill. I know people that went from a standard 40-hour work week to a standard 80-hour work week, doing 2 jobs to support their household, as opposed to the 1 job they had been doing. They didn't grumble. They didn't complain. They understood that they had a role in their family to provide for that family. They also understood that they had financial obligations. People like that didn't really worry about things like forbearance. But forbearance, mortgage forbearance specifically, because there's different kinds of forbearance out there. There's student loan forbearance. There's all kinds of things that the government is promising the American people. And there are some people, about 1.7 million of them, that I can tell from the stats I'm looking at right now, that are currently in some form of forbearance. Now, I know statistically, I was reading another article, and I'll be honest with you, I don't recall who the provider of the information was. I believe I read it in Forbes, and I also believe I read it on Yahoo Finance. The number of people in forbearance went to a pretty big number. I think I saw a number somewhere in the 7 million range. That's a lot of people. Now, if you look at all the people that actually own homes to live in, it's still a relatively big number. But many people did the right thing. They found a way to get out of forbearance. They either went out and found employment that allowed them to pay their mortgage on time, or they worked out a deal with their lender that said, I'm back in a financial position. I want to thank you so much for those 3 or 4 months that you guys allowed me to not make that payment. And depending on the arrangement that you made, maybe you caught the payments up, or maybe they just added everything to the back of your mortgage. However they did it, they got out of forbearance. Now, you have probably heard a lot of chatter in the news feeds, probably not in the mainstream media, but I'm pretty sure you've seen it in the news feeds, and you've probably heard it on the radio. There are people licking their chops because they think the fact that the forbearance protections are supposed to end at the end of this month, they believe that it's going to be a feeding frenzy in the markets. That all of a sudden, people are going to be like upside down and backwards, and all of a sudden we're going to see this massive flood of property hitting the markets. Massive flood of property hitting the markets. So much property hitting the markets that we're going to see downward pressure on pricing. As a matter of fact, we're going to see massive price drops. And I'm not seeing that. I'm not seeing that at all. See, what I'm seeing in the marketplace is a total scarcity of inventory. There's no bubble out there. There's no bubble in real estate. It's not out there. It's a supply and demand thing. More and more articles that I'm reading are supporting my argument. Less and less articles are trying to make the argument against me. And I'll tell you where I get my information from. A lot of quality real estate investors in the Lifestyles Unlimited community, as well as doing my own research. Because I'm educated and I know what to look for. When we come back from the break, let's talk about this flood of houses. Stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. All right, forbearance. It's a big word. It's a big word. It means a lot of different things, but really in the real estate context, it means you pretty much worked out a deal with the entity that is loaning you money to help you buy and pay for that property. Yeah, so if you're like most Americans, when you went to go buy a home for you to live in and consume, you probably took out some form of mortgage. Now, not everybody does that. Some people pay all cash for properties that they consume. It's personal preference. It's also an ability for you to go out and buy something that maybe you wouldn't be able to buy because you don't have all cash. There are lending programs out there that are designed for first-time home buyers. It's called the FHA loans. They set limits on what you can buy, but the program is really designed to help prospective homeowners buy real estate by putting a little bit of money down. See, with an FHA loan, you can qualify for whatever you can qualify for, and you can put 3.5% down plus some closing costs, and you can get into a house. So what does that really mean? Well, if you're a first-time home buyer and you're looking to buy a house that, say, costs $200,000, if you go to a standard conventional financing, they want you to put 20% down. That means you got to come to the table with $40,000. But if you use an FHA product and you qualify, you can come to the closing table with $7,000 in down payment. Now, you're going to have some PMI. It's called MIP. It's one of these little insurance products that you're required to put on the loan, which helps to guarantee the lender's position because they're going to wind up loaning you more money. That puts them in a higher risk category. You pay some kind of mortgage insurance premium. Just means if you don't have at least 20% down, you're going to pay an insurance premium on the difference between what you did put down and the 20% you didn't put down. And when you finally get to the point where you have 20% equity, you can have an appraisal done on the property and thereby prove to the lender you now have a 20% equity position and you can make that stuff go away. Yeah, that's kind of how it works. So think about it. Who really gets hurt the most when you have to go to forbearance? Well, it's the people that bought property just prior to the pandemic, that bought with FHA financing, that were classified as non-essential workers, who didn't receive enough money from the government through unemployment to cover all of their expenses. And as a result of that, maybe they sat down and they looked at, okay, if we go to a forbearance thing, first of all, there's certain rules and protections with the way the forbearance system was laid out. In other words, if you ask for it and it's granted to you by your lender, you're basically going into an agreement where you guys are just kind of hunker down. Yeah, you guys are going to hunker down. In other words, that lender agrees not to foreclose on you because you have a material condition, which is, the same material condition that everybody else is dealing with. And as a result, you can't pay. And maybe that's the way you got through the pandemic until you could find employment again. Now, some people, they figured out how to get off that forbearance thing as fast as they could. They realized that if you get into this habit where you're not paying a mortgage payment, you can get yourself into cruise control that could hurt you financially. Now, I firmly believe there are people out there that have been in forbearance since the beginning. And financially, they need to be there because if they weren't in forbearance, there could be a total meltdown in their personal financial situation. I mean, that's really the intent of why the government stepped up and said, okay, we're going to create these business rules because what we don't want is the entire housing market to collapse. We don't want that to happen. And there are financial things going on in the world or not going on in the world that we have no control over right now because we're in uncharted territory. Yeah, the last time the United States dealt with a pandemic was like 100 years ago, the Spanish flu. Yeah, you weren't alive. I wasn't alive. Very, very few people that are alive today even witness that or even recall it. Yeah. But my point is this. If you're somebody that is looking at the numbers and in your mind you're thinking, all right, well, I'm in forbearance. I've been in forbearance for 18 months. Let's say my mortgage payment was $2,000 a month, which I couldn't pay, but my lender agreed to take those payments and add them on to my loan on the back end. So if I did an FHA loan for a $200,000 house, and that loan is $193,000 because I put $7,000 down, and I went 18 months without making a payment, essentially that loan's going to go from $193,000. I mean, it's $2,000 a month times 18, right? So that takes it from $193,000 to $229,000. One of the benefits that's going on in today's real estate market is a scarcity of inventory. I mean, I'm looking at a Zillow report right now, and they're saying there's like a little over 2 months worth of available inventory out there. That just means it's a hardcore seller's market. So when property goes on the market, there's so much demand for it, it's bought. And the higher up you go in the price scale, the more relief you get from that. But people looking to buy properties and say the $250 price point, multiple offers, because there's a lot of people that can buy in that price point. So here's what I'm thinking. If you're concerned that you can't absorb a higher mortgage, say $229,000 on that property, and given the fact that real estate values have gone up, you're probably going to be okay. You just got to get yourself on track and used to making payments again. But if you don't think you can do that, if you don't see a solution that gets you beyond the ending of forbearance, you could sell that house. You could sell that house. I mean, think about it. You could sell that house, have that loan paid off, and you could walk away scot-free. And that's what a lot of people are like salivating over. They think that there are a ton of people that are so desperate right now that there's going to be a flooding of the market of inventory. And I don't think that's true. I absolutely don't think that's true. As a matter of fact, I was reading a Zillow report they did back in August. They did a pretty comprehensive analysis of this forbearance thing and what could potentially happen when the thing terminates at the end of September. Their findings are there will be an increase in inventory. There will be an increase in inventory. But it's not going to be so significant that we're going to have a flooding of the market and prices dropping. It's not going to be that way at all. When we come back, I'll give you the stats. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. All right, I need to clean up a stat that I threw out earlier in the show, and I know better. I'm one of those guys that will tell you never shoot from the hip. Always take solid aim at your target. And you know what I did earlier in the show? I went, I'm just going to use a stat off the top of my mind because I'm pretty confident I remember what the stat was. Well, I got part of the stat right, but I didn't get the whole darn thing right. So let me clean up that mess that I created. All right. So earlier in the show, I said that based on what I had been reading, I'd seen this on Forbes' website. I'd seen it on Yahoo's website. And the stat I said was 7 million people. It was actually 4.7 million people. That's kind of a big difference, right? It's still a pretty big number. It's still a very big number. And what that number represents, according to Black Knight, they're the ones that actually tabulated this information. They determined back in May of 2020 that there were approximately 4.7 million active forbearance plans for mortgages in place. When they reviewed their stats again last July, they determined that number fell by over 60%. As of July of 2021, Black Knight reports that there are approximately 1.86 million homeowners that are still in forbearance. And they estimate that to be about 3.5% of all borrowers with a mortgage. Okay. Is it a huge representative population? Not really. Not really. And of the 1.86 million people that are still in forbearance, how many are actually going to make the decision to step away from that house? How many will make the decision to put their property onto the market and sell that property and make it go away? And then maybe, because their credit hasn't been damaged or anything like that, when everything is back to reasonably sound in their life, they can go buy another house. I believe, and the stats that Zillow shared, which I'm going to share with you in a moment, the stats that I'm looking at are telling me that even if, say, 50% of those people sell or wind up in the foreclosure process because maybe they just stayed in forbearance too long and they can't dig out from underneath of it, even if 50% of all of those homes hit the market, all that's going to do is increase our months of supply by 1.78%. Now, why is that significant? Well, I told you earlier that we're looking at a month of supply. In other words, the way the housing market is kind of measured as to whether it's a seller's market or it's a buyer's market or a balanced market, they like to use months of supply of inventory, and that tends to give us a general understanding of what's going on in the marketplace. So when we're with less than 3 months of supply, which is where we're at right now, it's a seller's market. That's why buyers are complaining that they're having difficulty finding places to buy because the sellers aren't selling. They're not putting their properties on the market. There are people that are going, hey, man, I'm going to wait this out. I'm not stupid like Al. I'm not going to sell my house, harvest money, and then go back into the buying process. No, I'm going to wait for all this to settle down. And by the way, the value of my house is going up, so there's no need for me to sell. I'm not going anywhere. I'm not doing anything. I haven't been transferred. No reason to sell. Seller's market. 4 to 5 months, according to Redfin. 4 to 5 months is a balanced inventory. In other words, if you have 4 to 5 months worth of available inventory in the market, it's pretty much a balanced market. And when you get to, say, 6 months or more of supply, it tends to be more of a buyer's market. Now, there are people that are going to try and time these markets, and I'm just going to tell you, don't try and time the markets. Do what you need to do based on your strategies. And if the markets produce a result for you faster, it's okay to act on it. There's nothing wrong with that. There's real estate being transacted every day in this country. As a matter of fact, there's a lot of Lifestyles Unlimited members that made a lot of money during this pandemic, and they didn't abuse anybody or rip anybody off. They just stayed focused on what they were doing, and people need a place to live. So this whole pandemic thing and this whole forbearance thing, I think it's a lot of smoke and mirrors, because in the worst case scenario, and that's assuming that half of those 1.8 million homes are going to eventually get onto the market. And if that happens, we're only going to jack up the overall inventory cumulatively by 1.78%. But then if you actually look at the projections by months, we're really only jumping the supply by like 0.1%. So if you're at 2.4 and you add 0.1, what do you get? You get 2.5. What does 2.5 tell you? Well, it's less than 4. Therefore, according to Redfin, we're in a seller's market. Yeah, it's going to be a seller's market for a while. There is not enough forbearance action out there to significantly change the trajectory of this market. There's not. Now, there might be a benefit to you looking to buy property because, okay, there may be a few more houses available for you to acquire, but don't expect a windfall of properties to hit the market. This is not 2008. You have to fully understand that. See, in 2008, when the financial conditions and what was a soaring housing market pushed many homeowners into involuntary foreclosure, because remember what happened. The market peaked because the lending side was out of control. People were getting loans they had no business getting. They kept buying and literally flipping houses, making money hand over fist. Everybody you knew, everybody I knew was making money in real estate. Okay, you can't sustain that kind of market. And when that market finally got to its peak, it finally arrived at its peak and could go no further, that's when everything started falling apart. That's when the market started to crumble and pricing went down. So now you had people that were speculating at higher prices that are now underwater with their properties. So what do? A lot of them just walked away. I don't care. I'm out of here. I made my money. I'm good. Which just created more damage to the markets because now you have property that has to be foreclosed upon that needs to be disposed of. Therefore, you're putting more inventory back into the market at a period where prices are declining, but nobody wants to buy that because prices are declining because the market got out of control. That is not happening right now. That's not even close to what's happening right now. As a matter of fact, because of the way the markets are reacting with the scarcity of inventory that's out there, property prices are pushing upwards, which is actually benefiting people who may be in a forbearance situation that they're very concerned about. The fact that the market is extremely healthy is very beneficial to people that were damaged financially by the forbearance. And if you're one of those people, you need to sit down and figure out an exit strategy for you. Because if you've been riding forbearance and the end is coming and you can't pick up where you left off, this is a great time for you to get out of that property. Save your credit. Do not get a foreclosure on your credit. Start again. Let that property go. Let it go. Let somebody else buy it. It's okay. It's okay. You'll find another house that you love. And for all of you out there frothing, oh, yeah, we're going to get all these properties, and we're going to see just a windfall. I don't see it happen. It's not going to happen. I'll go on record saying I don't think it's going to happen. I think we're going to see continued upward pressure. So here's my point. If you're not in the real estate market today, if you're not investing today and prices are going up, you're just going to pay more for that real estate in a future date. Get on board. Get on board. Get involved with a rising market. I will tell you this. When you understand what we understand at Lifestyles Unlimited, you'll realize that you can get yourself retired in the next 5 years. And if you want to find out how, go to lifestylesunlimitedworkshop.com.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.